Hello, everyone. All right, glad to have you here. As most of you know, my name's Todd Mitchell, and I want to welcome you to the Big Profits with Low Risk Swing Trading Strategies workshop. And I want to thank each and every one of you for taking your valuable time out of your busy schedules to join us today. We really do appreciate it. Okay, I do see tons of familiar names from literally all over the world, as we do all the time, and I appreciate you coming out. Really glad you could make it. So again, thank you, okay? Now, with all the calls and the emails that I've been getting this week, I know the anticipation's pretty high because we've got another brand new workshop. And again, we got quite a few people in here tonight, so we're almost at capacity right now. So great. And again, this will be recorded. I just want to put that out there. Again, before we start, I want to make sure that everyone can hear me. So if you can hear me, just type in something so I know that you can hear me. Yep. Okay, getting a lot of people typing in. Good. Glad you can hear. Okay, the screen's looking good and clear. Right. Good. All right, we have about an hour. This will be about an hour. Now, not quite an hour and a half, so not quite as long as some of our longest workshops. I would say about an hour and 20 to an hour and 25 minutes it should run, okay? But rest assured, it will be full of actionable trading strategies that you can literally start using tomorrow if you want. So be sure to grab a pen and paper and get ready to take some notes. And for those of you that are wondering, and I just answered the question, yes, I'm seeing some of you are typing in, is it going to be recorded? I can't stay the whole time. So yes. It will be recorded, and it will be sent out to you about an hour or two after we finish today, okay? And again, if you want to ask questions during the workshop, just type those in the box below, and Roger will sporadically answer those for you as he's talking, okay? And of course, I'll be here, and we've got an assistant here also helping me answer questions, and we'll type those back to you, okay? All right. Now that we've got that out of the way, it's now time to pass the mic over to my good friend and trading associate, Roger Scott, where he's got a fantastic, as usual, and brand new presentation for you today, okay? Then I'll be back to wrap it up and answer any remaining questions that you may still have, okay? Does that sound good, everybody? Great. All right, and as you all know by now, Roger's an ex-hedge fund manager that took $20 million to about 750 million in just 11 years. So he's definitely worth listening to. He's been on with us, as you know, quite a few times by now, and the feedback is always fantastic. So sit back and enjoy. Okay, so without further ado, I'm going to hand the mic over to my good buddy, Roger. Roger, are you there?
Yes, I am, Todd, and thank you. I really appreciate that introduction. And I'm really happy to be with you and your Value Trading Concepts group today, as usual. So thank you once again. So let me start off by telling you what today's game plan is going to be. This way you can prepare your questions ahead of time. And Tom from Colorado was asking if I'm going to talk about options and ETFs. And Tom, thanks so much for attending today's workshop. And to answer your question, everything that I'm going to discuss today is applicable to stocks, ETFs, and options. And most of the material can also be applied to other markets, such as currencies and futures. But yes, you can apply everything that I'm going to discuss today to stocks, ETFs, and options. And Tom, if something comes up and it's not related to options or doesn't work well with options, I'll make sure to point it out so you don't get confused or misled. And thanks again for participating today. I do appreciate it. So I'm first going to show you a simple but very effective way to trade breakouts or momentum strategies, while at the same time eliminating a large percentage of losing trades by following a few basic principles that I'm going to go over with you today. And these are very basic tips, and I find that they can make a big difference. So we will start off with this topic today. I'm then going to move on to basic technical analysis principles and show you how combining simple indicators and simple technical patterns can create very powerful trading filters and complete strategies that can be used to identify potentially high reward and low risk trading opportunities. And we have a question from Simon from Florida. And Simon, thanks so much for being here today and for participating in today's workshop. And Simon is asking if he needs any special software to utilize these methods, and if he needs real-time quotes or charts. Simon, everything that I'm going to explain and teach you today can be found on any free technical analysis program that you can find online. And some of the setups don't even require technical indicators. So for those, you only need technical charts. And Simon, everything I'm going to show you is applied to daily charts. You don't need real-time data, minute or tick charts. You don't have to sit in front of the computer during the trading day for these strategies. The methods and the techniques I'm going to show you can be accomplished even if you have a full-time job. So there's no need to spend any money on any technical programs or real-time data. And I hope I was able to answer your question, Simon. Moving on, a few weeks ago, I presented a workshop that talked about market breadth indicators. And I received lots of emails asking for more market internals and how to combine market internals with traditional indicators. So today I'm going to go through another example of how I use market breadth, but this time I'm going to mix market internals with basic technical indicators to help us determine if the bulls or the bears are in control of the market at any given time, and give you a better idea of whether momentum is moving in or out of the market. Many traders are turning to market internals because they're not distorted and are great indicators to use as a confirmation filter when your technical indicators are giving you an opposite reading. And I think you will find this analysis very useful. So moving on, I've also received several emails asking for more stock screening examples. And today I'm going to show you another screening example. And this time I will show you a simple momentum screening tool that can help you find stocks that are outperforming the overall market to the upside as well as to the downside, giving you higher odds of finding the best swing trading candidates quickly and easily. And Gina from Long Island says she has a pen and paper and she's ready to go. Gina, I'm glad to hear that, and I promise I'm going to give you lots of actionable trading info today. I value your time and I want to make sure you get something out of today's workshop. And before we wrap things up today, I'm going to show you a simple but effective swing trading strategy that generates consistent profits and low risk per trade. And this strategy is based on simple trading principles, and it's very effective. It has a profit to risk of 2 to 1 and is very effective for swing trading any type of market because it's a pullback method. So it works well with options as well, because volatility is a bit lower when markets are pulling back. And I will go through that when I talk about the strategy before I wrap things up today. So that's the agenda. And before I begin, I want to tell you a little bit about myself. If you've been to my past workshops and heard all about my life story, I do apologize for making you have to hear this part again. But I promise I will keep it as brief as possible for everyone's sake, including my own. I originally started trading back in the early 90s when one of my closest friends introduced me to the stock market. I actually started right around the time that I began law school, and while I'm very happy that I finished school and earned my law degree, I actually never practiced law and was fortunate enough to make my living from trading while I was still in law school. After I graduated law school, I got a job working for a small brokerage firm. And less than a year later, I opened my own trading company. And shortly thereafter, I was managing 2 funds, which at their peak were at about $750 million. I was trading stocks, options, futures, and Forex, and several different commodity markets. There were no ETFs during this time, but I was trading different markets in different time frames and testing several different trading strategies with a staff of professional engineers who were helping me backtest different systems. So while my professional career was doing well and I was becoming more and more successful, I was married and I had 2 small children who were growing up very quickly. And I found my life absorbed by my career and I wasn't finding any balance. And as a result, I was in a chronic state of stress, frustration, and anxiety. And something had to change quickly. And right around this period in my life, I was approached by a few close friends with the idea of starting an online trading education firm with a focus on real trading education. And looking back, I have to say that it was the best decision that I've ever made because I absolutely love trading and I have a true passion for teaching others. And because of the internet, I don't have to travel and I can teach online from my office, which is only a few miles from my home in Malibu. And before I get into the material, I want to ask you to participate. I rely on your questions and I use them frequently in future workshops. And I found that if one of you has a question, then the odds are high that others have a similar question. So please don't hesitate to ask questions. They're much better than the ones that I come up with. And because we have so many people here today, if I don't answer your question during today's live presentation, I promise that I will answer your question within the next few hours. I take your questions very seriously, and I want to make sure all of your questions get answered today. And lastly, before I begin, I'd like to go through the required government disclaimer. I will give you a minute to read it, and I will paraphrase it for you, because it's based on common sense. And you should take this disclaimer seriously. In a nutshell, don't trade with money that you cannot afford to lose. This means that you should not trade with your retirement funds or money that you saved for your kids' college or your medical bills. Remember that trading with money that you cannot afford to lose creates additional emotional pressure, and mental stress is your worst enemy when it comes to trading. So don't put yourself in that position. Furthermore, margin can increase your risk beyond your investment because margin is leverage, and leverage increases your risk substantially. When you're first starting out, you should paper trade or trade with very small share size till you're familiar and understand the strategy and the propensity of that particular strategy. That's what I do when I start out with a new trading strategy, and that's what I recommend you do as well. Okay, so let's talk a little bit about momentum style strategies and how to find the most reliable setups that give you both the highest probability of moving directionally for at least a few days, and at the same time don't take too much in terms of risk. And we have a question from Matt from Washington State. Matt, thanks so much for being here today. And Matt is asking if these methods apply to both the long side as well as the short side. And Matt, every strategy and tactic that I'm going to go over today applies equally to the upside and the downside. Aside from one volume spike strategy that I utilize, I trade everything to the upside and downside equally. So to answer your question, Matt, yes, you can apply these tactics to both the upside and the downside. And thanks so much for participating today, Matt. I really do appreciate your time. And I bet there's other traders who are asking the same question. And since I'm on the topic of trading short, Many traders don't like or don't feel comfortable trading to the short side. So if that's the case, I highly recommend inverse ETFs. And these are ETFs that trade to the opposite side of the market and make very good alternatives for traders who don't like trading to the short side. So keep that in mind, Matt. Remember, if you don't trade to the downside, you miss 50% of all trading opportunities. And that's not something you want to do. Okay, so getting back on track, many years ago, I tested about 30 different entry time frames. I used simple breakouts, and I started with the 20-day and went up all the way to 200 days. But there's something about the 90-day breakout, and I don't know what it is exactly, but I tested every possible market, including stocks, futures, commodities, and currencies, and thousands of different stocks, and the period between 85 and 95 days tends to yield the best percentage of profitable trades. And we have a question from Aaron, who's in South Carolina. And Aaron, thanks for being here today. And Aaron is asking how exactly I calculate the 90-day high price, if I include all days or just trading days, and if I use the closing price or the highest price. And Aaron, these are both very good questions, and I'm sure others want to know the answer to these questions too. So thanks for asking. And to answer your question, Aaron, you only use trading days. Whenever I measure days, I'm always referring to actual trading days, days where you would see price data on the charts. So if the market doesn't open on Monday or Friday because of a holiday, you wouldn't count that day. And you wouldn't count weekends either. And to answer your other question, whether I rely on the highs or the closing price for the 90-day high or low depends on the strategy that I'm trading. And this actually leads me to another point that's related to what you just asked me, Aaron. Some of the strategies that I use require you to enter on the close the next day after the 90-day high was reached. And other strategies require you to enter on a buy stop. The point I'm trying to make, Aaron, is that I tested about 10 different entry variations that were all different, but at the same time all focused on breakouts. And I was adjusting the time frame from 20 days to 200 days. And the most reliable time frame was always near the 90-day time frame. And as long as you enter near the 90-day period, either the next day or the same day, and on the close or the opening the next day, but as long as you are consistent, your results over the long run will not be any different. Some trades will be bigger winners and others will be bigger losers. But in the long run, it will make zero difference in your performance numbers. And I hope that I was able to answer your question, Aaron. So moving forward, what I did over the years was look at my most profitable momentum trades, the ones that resulted in the best gains. And I noticed that not all 90-day price highs and lows were created equal. And over time, I actually found that certain 90-day price highs and lows have a much better profit to loss ratio than others and tend to have a better or higher probability of continuing moving in the direction of the trend and continue building up momentum. So what I'm going to show you is which 90-day high you should avoid and explain to you why you should avoid them. In this example, you can see a 90-day price high and notice that volume is much higher. In this case, the price high was triggered by earnings. And I found that if the reason behind the 90-day price high is earnings, the 90-day price high tends to have a very large percentage of false breakouts. Meaning, if you find the 90-day price high that was triggered by earnings, the odds of that stock moving higher is not as high as if the breakout that was not triggered by earnings. So consider that as one of the factors that you use when looking at 90-day breakouts. And we have a question from Sean, who's in New Mexico. And Sean is asking if it matters if the earnings came after the 90-day breakout or before the 90-day breakout. And Sean, that's a very good question. and I appreciate you taking the time to be here today and to answer your question. If the 90-day high occurs the day before the earnings come out, it doesn't have as much of an impact. But what you want to avoid is when the stock earnings, after they are released, cause a rally in the stock. But if the stock hits a 90-day high and then the next day earnings come out that cause the price to go higher, that's not an issue. And I wouldn't worry about that scenario having too much of an impact on price. And I hope I was able to answer your question, Sean. Okay, so there's one other scenario that you want to avoid. And it took me many years to figure this one out because it's not something that's easy to backtest. So I had to visually look through thousands of charts over many years to finally spot this scenario. So when you find stocks that are making a new 90-day price high, either closing high or highest high, that doesn't matter too much. But what does matter is how far the stock is extended from the base. Take a look at this example of ticker symbol AEM. Notice how the stock was range bound between the 22 and the 27 level for 2 months, and then began moving higher. But when the stock finally hits the 90-day high, it moves a bit higher, but then begins to run out of momentum rather quickly. The reason this is the case is because the 90-day price high was too far above the base that this stock created. So what I learned, and this is very basic but very effective, is to pick stocks that are making 90-day price highs very close to the base or the range-bound price action that they created prior to the breakout. In this particular example, you can see a 90-day price high that's very close to the base. This is the type of pattern you want to see when the breakout is strong and it comes right after the congestion. The move tends to be much more powerful than when the breakout occurs after the stock already had a chance to move higher, after the basing range-bound pattern. When you see breakouts from overextended stocks, it typically occurs because the stock is pricing something into its price that a few insiders or company employees already know. And by the time the stock breaks out, the only ones who are not aware of the news or the catalyst is the retail buyers, who end up pushing the stock just enough to cause a reversal or the price to stagnate. And you don't want to be in either of those positions. Here's another example. Notice how the breakout occurs from a tight trading range. This is the type of breakout you want to look for if you want to find strong momentum moves that give you a high reward to risk. Because if you trade 90-day breakouts that are overextended at the time of entry or 90-day breakouts caused by earnings news, you will eliminate any of the upside that the 90-day breakout will give you. And from a statistical perspective, you don't want to do that. So always make sure you consider these two factors when trading 90-day breakouts. And we have a great question from Nate from New Hampshire. And Nate, welcome to the workshop. And Nate is asking if any other company news other than earnings play a role in increasing or decreasing the odds of a breakout continuing or failing. And Nate, according to backtests, the only factor that influences or increases the percentage of false breakout is the 90-day breakout occurring as a result of earnings. Otherwise, there were no factors that influenced the percentage of profitability other than overextended prices. And I hope that I was able to answer your question. We have another question from Ryan from San Diego. And Ryan is asking how long each trade was held for on average. And Ryan, thanks for participating. And I have to say that today we really have good, relevant questions. And I really do appreciate that. And Ryan, to answer your question, the holding period ranged anywhere from 5 days to 40 days. I don't remember exactly, but it was somewhere in that ballpark. So between 1 week and 5 weeks or so. And the losers, Ryan, in case you're interested, they were held on average for 6 days. And I hope that answers your question, Ryan. So moving on, I want to show you how I combine the 90-day breakout with two simple filters. I use these filters consistently in my trading, and I find that when I combine these two very simple filters with the 90-day breakout, my trades tend to have a higher percentage of profitability and tend to generate more directional momentum. And I've been using these patterns for a very long time now, so I wanted to share them with you today. The first filter is the ascending triangle. And what I do is combine the ascending triangle with the 90-day breakout. And you can see in this particular example exactly how the trade sets up and the follow through. And what I do is enter right after the price trades above the horizontal area of the triangle. This one particular setup is one of my favorite setups. And we have a question from Glenn, who's in Milwaukee. And Glenn, thanks for participating today. And Glenn is asking if I trade the symmetrical triangle. And Glenn, that's a great question. And honestly, I don't find the symmetrical triangle to give me the type of move that I'm looking for. The symmetrical triangle can break out in either direction. It's a neutral pattern. But I prefer the ascending triangle and the descending triangle. I find them to produce better or higher degrees of momentum after the breakout. So I avoid the symmetrical triangle for that reason. And I hope I was able to answer your question, Glenn. So here's another example. And you can see how the pattern sets up and the follow through as well. Once again, I usually wait for the price to trade completely above or outside the triangle before I initiate the trade. And I place my stop loss slightly below or inside the triangle. So if the price moves back down and trades within the triangle, the trade would be invalidated and I would exit the trade at that time. This is one of the reasons why I like the ascending and the descending triangle. Because you know within a very short time after the breakout and with very little risk, if in fact the trade is going to move in your direction. That's one factor that you will find in all of the setups that I trade. There's very little wiggle room in terms of whether the trade is working out or whether it's going to fail. And if you consistently keep taking trades where the risk is predefined and you know right away if your trade is going to be a loser, you can cut your losers quickly and move on to other trades. And we have a good question from James, who's in San Francisco. And James, welcome to the workshop, and thanks for participating. And James is asking how long it takes for the triangle to form. James, that's a great question. And to answer your question, for the bottom ascending line, in case of the ascending triangle, I like the upslope to take no less than 10 trading days, or 2 weeks. And the upper flat top, or the horizontal resistance line, to take anywhere from 3 to 5 weeks to form. And these are not set in stone, but that's the typical triangle, James. And I hope I was able to answer your question. So the next filter I like to combine with the 90-day breakout are gaps. And before I get into the setup, let me give you a quick 101 on gaps, so you have a bit of perspective on what I'm going to talk about next. There are 3 basic types of gaps, and each one of them occurs at a different time during a market cycle. So it's very important to be able to identify the type of gap that you're seeing, because it can dictate whether or not the stock is beginning a move, continuing a move, or alternatively at the last leg of an up move when the market is getting ready to drift sideways or come back down against the current trend. And this example is actually a very simple but a very effective representation of the 3 different types of gaps. And more importantly, you can see when the gap occurs in relationship to the underlying price movement. So you can see that the breakaway gap occurs right at the point of a breakout. And this is usually the first gap to occur in a market cycle, when the stock or whatever other market you're trading is in the beginning of the trend cycle. And this happens to be the lowest risk and the highest opportunity to profit from a price move.
right when the momentum first begins. Because at this stage of the cycle, the great majority of activity is directional, and there's very little adverse price moves and substantial follow-through. So breakaway gaps are very desirable for entries. And then we have the continuation gap, or the runaway gap. And the continuation or the runaway gap is exactly what it sounds like, and occurs after the market had a chance to run up a bit. The continuation gap occurs in the middle of the market cycle, after price had a chance to move roughly 50 to 60% of the entire trend cycle. And when I'm swing trading, I rarely stick around long enough to experience continuation gaps. These usually occur a few months after the initial breakaway gap occurs, and swing traders are usually out before that time. So to continue, the last and final type of gap is an exhaustion gap or a reversal gap. And this gap, more often than not, signals the end of a trend and the beginning of a range-bound cycle. Or sometimes, in rare cases, the exhaustion gap actually does signal a reversal. And I've said it before and I'll say it again, but reversals are not a practical way to trade, because more often than not the market will drift and not move down for several weeks or even months. So the exhaustion gap, or reversal gap as it's called, does not tend to generate strong momentum moves like the breakaway gap, for example. So I wouldn't use it as an entry filter, because you can end up getting stuck for a long time. Okay, so now that I gave you a bit of a general background about gaps, the gap that I use, and you probably guessed it by now, is the breakaway gap. And what I do is combine it with the 90-day breakout once again. And I'm simply using two very reliable indicators or patterns and combining them together to increase my odds of finding stocks or other assets that will give me a higher than average chance of moving either strongly higher or strongly lower over the next several days, with a high amount of momentum and follow through. And that's exactly what I want when I'm swing trading and looking for short-term opportunities when I'm holding positions on average anywhere from 1 week to 3 weeks. So in this example, you can see ticker symbol CODE, code, and you can see a breakaway gap combined with a 90-day breakout to the upside. Notice how the breakout and the gap occurs following a strong congestion range. We still want to make sure that the gap is not a result of earnings, but otherwise this is what a breakaway gap combined with a 90-day average should look like. And we have a question from Albert from Kansas. And Albert, welcome to the workshop. And Albert is asking if this particular setup works well with options. And Albert, that's a great question. And I was actually just about to get into that. Any strategy that's based on breakouts or momentum style trading techniques, especially 90-day breakouts, breakaway gaps, or triangle patterns, are going to have a high level of implied volatility. And I recommend pullback strategies for options because volatility is on the low end. And a bit later, I will talk about a pullback strategy that works well with options. But overall, what I did find is that if you're going to use options to trade these type of strategies, is to treat the option like an underlying stock, meaning buy options that are at or in the money, and buy options that have at least a few months to go. What I find about 75 to 80% of the time with traders applying these strategies to options is the opposite of what I just recommended. In other words, most traders buy options that have a very short time till expiration and are out of the money, and these options are not ideal options for swing trading when you need a reasonable size move. Basically, these options start moving your way after the underlying already reached the profit target. So my advice is to buy options when you're using pullback strategies, or if you want to trade momentum or breakout strategies, you should consider buying more expensive options that are a bit in the money. These options tend to move much closer to how the underlying market moves, so you will get a direct benefit from the underlying move. And I hope that answers your question, Albert. And this is another example of a breakaway gap that's combined with a 90-day breakout. And notice again how the trading pattern that leads to the breakout is very predictable and range-bound. This is the type of pattern you want to see prior to the breakout. And the longer the stock, or whatever other market you're looking at, stays in this pattern, the better the move that originates from the congestion. Remember my very basic rule. The longer the market stays in a range-bound cycle, the better the subsequent trending cycle. And the longer the market stays in a trending cycle, the longer it will be in a subsequent range-bound cycle. And this setup is a very good example of this very general principle. And we have a very relevant question from Tony from Chicago. And Tony, I want to welcome you to the workshop. And Tony is asking how much of a price gap I need to see between the previous price and the gap day's price. And Tony, I actually get asked this question all the time. And the actual number varies based on the price of the stock. Just like where I set my buy stop levels, I use simple common sense. So, for example, if the stock is priced at $20, I would be fine with a gap of $1. But if the stock is priced at $100, I would probably want to see a gap of $4 to $6. Similarly, if the daily range of the stock is $1 and it's a $50 stock, then I would probably be impressed with a small gap, such as $1. But if it's a $50 stock that has a range of $4 per day, then a $1 gap wouldn't interest me too much. So I take into consideration the price of the instrument or the asset, and I take into account the average volatility or the average price range between the highs and the lows. And that's what I use to determine whether the gap size is large enough or if it's not. And I hope that answers your question, Tony. So moving ahead, over the past few months, I've been receiving more and more emails about incorporating or applying market breadth indicators. And market breadth is just a fancy way of saying market internals. And this is when we use the actual components of the stock market instead of indicators that are derived from market price. So, for example, if 500 stocks are making new highs and 800 are making new lows, that's considered a market breadth indicator. Or for example, if more volume is coming into stocks that are moving higher compared to volume of stocks that are moving lower, that's another example of market internals. So whenever you measure the actual components that make up the market, you're really looking at market internals or market breadth, and not technical analysis, which is made up of market price. And a few weeks back, and it might have been longer than that, time really does get away from me. But nevertheless, I demonstrated a few different ways to use market internals, and more importantly, where to find these numbers very quickly. And to the best of my knowledge, the first market breadth analysis that I demonstrated involved looking at 52-week highs and comparing it to 52-week lows. And the second example, which I did recently, compared stocks that are making short-term highs or lows with stocks that are making longer-term highs or lows. And you would do this to measure short-term overbought or oversold levels. And today, I'm going to show you an all-new way to use market internals. And this involves combining a simple indicator with market internals. And I will explain the logic behind it first so you understand why it's important. And then I will show you where to find this metric. And we have a comment from Phil, who's in Texas. And Phil wants to thank me for showing him ideas that he can actually apply to the markets. And Phil, I appreciate the nice words. I don't want to waste your time showing you something that doesn't work or something that you can't apply to the market. So thank you, Phil. I appreciate the nice words. So let me explain to you a little bit about this specific market internal study and what I do and why it's very important to follow this particular metric. By now, most of you know that the 50-day moving average is a very important indicator. And to save everyone time who doesn't know why it's so important, it's because most large funds rely on it or use it as a market barometer. In other words, if the market is above the 50-day average, funds tend to be fairly aggressive to the upside. And if the market is trading below the 50-day moving average, fund traders tend to stop accumulating and begin moving money into safer investments like bonds, precious metals, and utility stocks. So the 50-day average has a very significant meaning. So you will notice that when the market begins dropping below the 50-day average, volume tends to be a bit lower than when stocks are trading above the 50-day average. And that's because there's a lot less fund activity when stocks are below the 50-day line compared to when they are above the 50-day line. So this is why the 50-day average is so important. It doesn't really hold any special value, and it's not particularly the best indicator for breakouts. The 90-day is much better. But because funds use it as a barometer, I use the 50-day average in my analysis frequently. So what I found through experimenting, backtesting, and more importantly, real-time trading over the last 20 years is when I combine the 50-day moving average with simple market internals, I get a really good reading on the current market environment. And what I do is keep my eye on the number of stocks that are trading above the 50-day average and compare it with the number of stocks that are trading below the 50-day moving average. And we have a question from Henry, who's in Ontario. Welcome to the workshop, Henry, and thanks for participating today. Henry is asking what type of moving average the funds use. And I guess I should have been clearer. But most fund managers use a simple 50-day moving average. Remember, Henry, this is not a market timing exercise. This is a simple tool used as a barometer of overall market strength and weakness. If you're using indicators for entry and exit, the 50-day exponential moving average would probably work much better. But in this case, we want to determine if the market is bullish, bearish, or neutral at any given time. And the reason you would do that, Henry, is to help you time your entry. So if the market is very bullish and 90% of stocks are trading above the 50-day average, you may want to be a bit cautious about initiating heavy long positions. And you may want to wait for a pullback. Or you may want to avoid buying call options because volatility is very high. Or you may want to consider taking partial profits on your positions. So these are just examples. But I want you to understand why we're looking at these numbers. And I hope I was able to answer your question, Henry. So let me walk you through this and show you how you can find this information at any given time. And there's no cost to do so. Just head over to barchart.com, and when you get there, click on the Stocks tab, which is right below the bar chart logo near the upper left-hand side of the page. And then scroll down, and on the left-hand side vertical bar, that's about 1/3 down the page, you will see a menu called Market Pulse. And what I do is click on the Momentum tab, which is the second tab after Market Overview and before New Highs, Lows. And when you click on the Momentum tab, you will see a title that says Percentage of Stocks Above Moving Average, and slightly below that is a graph with different columns that each have a different length of moving average identifying them. The first column is the 20-day average, and the second column is the 50-day average. And this continues all the way to the 200-day average, which is the last of the 5 columns. So the column that we're interested in happens to be the second column, the one that's appropriately titled 50-day moving average. And what I want to see is the percentage of stocks that are above the 50-day average, and also compare it to the number of stocks that are above the 50-day average 1 month ago. And based on that data, we can see that roughly 65% of the stocks are trading above the 50-day average. And more importantly, that number was at 35% 1 month ago. So we can see that currently the momentum is getting stronger and funds have been accumulating aggressively, at least over the last month. And Mike from Phoenix has a very relevant question. Mike, thanks for participating in the workshop. I do appreciate you taking the time. And Mike is asking, what is considered overbought? And Mike, generally speaking, I look at 2 factors. First, the percentage. If I see the percentage is moving above 80%, I will become very nervous that the market is very overbought. And similarly, if I see 80% of stocks below the 50-day average, I would consider the market bearish and due for a bounce. But I would also use other indicators to help me confirm this factor. But Mike, what's equally as important as the percentage of stocks that are below or above the 50-day average is the rate of increase over the last month. So, for example, if I find that the stock market went from 25% to 75% in 1 month, alarm bells will start going off, and I will be very cautious, because there's only so much momentum stocks can generate. And when you see the number increase from 25 to 75% of all stocks trading above the 50-day average, this tells me that the market is getting exhausted. So it's not just the percentage, but the rate of change during the 1 month period of time as well. So I hope that answers your question, Mike. So getting back to this example, you can tell simply by looking at the amount of stocks that are above the 50-day average that the market is currently in a bullish cycle, at least based on this analysis. And more importantly, we see that over the last 20 trading days, which is 1 month, market sentiment changed strongly. So if I see the percentage of stocks trading above the 50-day average move closer to 75%, I will conclude that the market is going to run out of momentum in the next few days. And that's because it takes substantially more buying pressure to move the percentage of stocks from 65% trading above the 50-day average to 75% of stocks trading above the 50-day average than it takes to go from 35 to 45%, for example. So it's not an even climb up. The higher the percentage goes up, the harder it is to make it go higher. So you have to consider that in your equation as well. And we have a question from Sam, who's in Brooklyn. And Sam, thanks so much for participating in today's workshop. I do appreciate your time. And Sam is asking, if he's trading tech stocks, shouldn't he be only looking at the percentage of tech stocks that are above or below the 50-day moving average? And Sam, that's a good question. And I'm sure others have a similar question. But you need to know that the markets are very correlated. And if funds are buying stocks, all stocks or most stocks will rally. It's like waves in the ocean. If the waves are big enough, everything in their way will move directionally. And the market is much the same way. You will find a very strong correlation between most stocks. And funds don't buy individual stocks. They buy baskets of stocks at the same time. This particular analysis is great for overall market analysis. And I always advocate that traders apply this type of approach to a broad market analysis, where they go through the overall market step by step and then look at individual stocks. Because the overall market is going to influence how the individual stocks perform to a great degree. And I hope I was able to answer your question, Sam. And thanks again for participating today. Okay, so the next topic I want to cover also involves screening. And it also involves bar chart. But this time, instead of showing you market internals, I'm going to show you a very simple filtering method that you can apply right away to your trading to help you find specific stocks and ETFs that are either strongly outperforming the market on a short-term time frame or the weakest stocks in comparison to the stock market, and once again on a short-term time frame. I experimented with different time frames, and I found that stocks that are making the biggest percentage gains over a 3-month period tend to continue doing so for another month or two. And similarly, stocks that are losing the most value over a 3-month period tend to stay weak or get weaker for another month or two. And what got me so focused on this metric is actually interesting, because I would spend hours trying to find stocks for my weekly hit list, and then I would end up finding more than half on the screening that I'm going to show you. So this is how I started paying attention to this metric many years ago. And now I use it, or at least double check my weekly list of stocks against this list. And more often than not, I will find that many of my picks are on this list as well. So it's a great way to find stocks that are gaining momentum either to the upside or to the downside. So once again, we head over to bar chart, and once you're on the home page, you want to scroll about halfway down and focus on the left-hand vertical menu. And this time we're going to go past the market pulse area and go further down to the performance part of the menu. And this section is actually divided into two distinct areas. The first one, the part that says performance, that deals with the bullish side of the market. So this is where you would find stocks that are outperforming the market on a variety of different time frames. And the time frame that I'm mostly interested in is the 3-month time leaders. This is the tab that will show you all the different stocks that are outperforming the market to the upside over the last 3 months. And I want to be clear with you. You still have to screen these stocks for daily range, volume, and correlation and other factors. But this is a great place to find stocks that are moving quickly to the upside and are outperforming the overall market. And if you're looking for candidates to trade to the short side, you would scroll down just a bit and go to the decliners section, which is right below the performance section. And the decline section will show you all the stocks and ETFs that are underperforming the market. And once again, I find that the 3-month time frame is the best time frame for swing trading stocks and ETFs and other markets for that matter too. It seems that these assets are in motion and tend to stay in motion for another month or two, so they make great candidates. And in this example, you can see the list of stocks and ETFs that you get when you click on the 3-month tab. To see all stocks and ETFs with the biggest percentage gainers over the last 3 months. And once again, you have to screen them for price, volume, volatility, and correlation, as well as other factors. But this is a wonderful place to start, and I highly recommend you use this resource to start building your watch list. And we have a question from Chris, who's in Baltimore. And Chris, welcome to the workshop. And Chris is asking if I can give a few criteria for filtering stocks. Chris, yes, I can do that, and broadly, you want to find stocks that are priced over $20. This way you know funds are looking at them. You should know, Chris, that large funds tend to stick to higher priced stocks. So stick to stocks and ETFs priced at over $20. Then you want to find stocks that have at least 200 to 300,000 shares traded daily on average. And you want to make sure you don't select stocks from the same or similar industry groups. And I hope I was able to answer your question, Chris. And thanks again for participating in today's workshop. Okay, so moving on, I want to show you a very simple swing trading strategy that I created many years ago. And I utilized this strategy in my own trading and also in the swing trading program. And the reason why I'm showing you this strategy is to give you a solid example of a very simple strategy that's worked very well for many years. Also, the strategy is a pullback strategy. So if you're an options trader, this strategy tends to enter when the underlying volatility is lower. unlike traditional momentum strategies, which enter on a breakout when volatility is high. The strategy is called tail gap, and I'm going to show you two examples of how I trade this strategy. And these two examples happen to be from actual trade recommendations, and they were setups that I actually traded. So let me give you the rules for the strategy, and then I will show you a few examples of completed trades so that you can get a feel for the setups and see the follow-through trade as well. The asset must make a 50-day price high and subsequently gap down and make a 10-day price low anytime within the next 15 trading days. The day the asset gaps down against the uptrend, the asset should ideally turn around and close in the top 25th percentile of the daily range, but still maintain a gap between the gap day's high price and the previous day's low price at the close. So this is an example of a setup so you can see what I just described to you. Notice Dollar Tree stock makes a 50-day price high and then within the next 9 days gaps down against the current uptrend. And the day the stock gaps down, it closes in the upper part of the daily range. And notice that there's still a gap between the day before the stock gapped down and the high that was reached the day the stock had the gap down. In this example, you can see the entire progression from beginning of the trade till the end. This is CarMax stock, and you would enter long on a buy stop, a few cents above the high that was made the day the gap was created, the day the asset made a 10-day price low and recovered by the end of the day. And once you're in the trade, assuming the stock traded higher the next day, you would then proceed to place your stop loss order a few cents below the low that was made on the day you entered the trade or the day before, the 10-day low, whichever day had the lowest price low. And the profit target is the difference between the entry and the stop loss, multiplied twice or 3 times, depending on market conditions, and then added to your entry price. This is typically entered as a sell limit order, and in this particular example, I multiplied the risk twice and added it to my entry price, and that became my profit target. Let me show you another example, and this is a short example. This is ticker symbol FXE, which is an ETF that tracks the euro currency market. And we wait for the ETF to make a 50-day price low and then pull up, and in this case, gap up anytime within the next 15 trading days. If we were trading to the long side, we would want the gap to be to the downside. But since we're trading to the downside, we want the gap to be to the upside. In addition, the same day the gap up occurs, I want to see the stock close in the lowest part of the daily trading range, preferably in the lower 25th percentile. And you can see in this example how FXE makes a 50-day price low and then pulls back for 7 days and then gaps up against the main trend but ends up closing in the lower part of the daily trading range. So once you find the setup, you would place a sell stop order a few ticks below the low that was made on the day the gap occurred after the closing. And if you're not filled the next day on your entry, the trade is nullified. So the asset has to trade lower the day following the gap for the setup to be triggered. And in this case, the ETF opens a bit lower and the sell stop is triggered and we're short. As soon as we enter the trade, we would place our protective buy stop order just a few cents above the highest price of the day, either the day of the entry or the day before the entry, the day the gap occurred, whichever day has the highest price out of the 2 days. And then the final step is to calculate the profit target, which in this case is twice the distance between the entry and my protective buy stop, subtracted from the entry price. and I typically enter it as a limit order and leave it there, and wait for a fill. And if this was a long trade, I would take the distance between my entry and my stop loss, double it, and add it to my entry price. And in case you're wondering how this strategy and my other swing trading strategies performed, this is the graph of the performance of the Swing Trading Lab program, which consists of the tail gap, the 90-day breakout, and 6 other swing trading strategies that I apply on a regular basis. We started the lab program in October of 2014, and up till a few days ago, my performance in the lab following the same type of trading strategies that I showed you, it's up over 557%, and my original investment of $50,000 has grown to over $328,000. And that's been achieved in just over 2 years or 30 months of time. So today I have big news, and I've been preparing for this for a long time now. And after much thought, we decided instead of reopening the swing trading program to new members, to instead create a new swing trading program. And as most of you already know, I take my training programs very seriously, and I don't offer anything unless I'm ready to put in 110%. So right now, I'm finally ready. So today, I'd like to introduce you to our brand new swing trading program, and it's called Swing Trading Lab. And I want to tell you a bit about the Swing Trading Lab mentorship program. After working with the original swing trading program for several years, I learned from trial and error the ingredients that traders need to succeed. And I leveraged 3 main components into this program. And these 3 components are vital in helping you achieve consistent long-term success. This includes trading methodology, daily trade setups, and market analysis. And I will give you some details on each one of these next. The first component is trading methodologies. So I took 8 of my most reliable and consistent swing trading methods, and these methods involve either pullback entries or momentum entries. So if you're an options trader, there's plenty of setups to keep you busy. One of the methods is actually the tail gap, the one I demonstrated a few minutes ago. And Sniper, which is one of my premium strategies, is also included. So there's a total of 8 strategies that are explained in great detail and are traded in the program. Each night I generate setups for the next day, and the setups are based on each of the 8 strategies. And some of the setups are long and some are short. This depends on market conditions. So you will find that there's a combination of trade advisories or setups. And I don't just give you the setups. I give you the entry price range, the exit price range, and the protective stop loss range. And I even give you the share size based on a $500 risk per trade. So if you want to risk $100 per trade, for example, you would just reduce the share size by 5. And if you wanted to risk $1,000 per trade, you would just double the recommended share size.
And I give you anywhere from 2 to 4 trade setups daily.
And you don't have to trade each setup, and you won't get hit on each one. But it's not one of those programs where you enter a trade once a month. This is for active swing traders who are looking for daily trade ideas. In addition, I created a closed trade tracker where you can see every trade that was taken by me personally. And I only take trades that are part of the daily setups that I put out after the close each day. So I take the same trades as you, and I show you the winners and the losers after the position is closed out. This way you can begin to develop a real understanding of what the setups are supposed to look like by looking at the actual trades that were taken, like the example of the tail gap that I showed you today. That was a trade that was taken from the Swing Trading Lab members area. Every trade has a link to a graph that has a complete trade from the setup to the end of the trade to help reinforce how the setup looks like as well as the follow through. And I know that many of you want to know more about the setups and the strategies. And these are my bread and butter strategies. And they hold trades anywhere from 3 days to about 15 days on average. Some trades are held longer, and some trades are held less. But this is the average, to give you some idea of the holding period. And because I trade stocks and ETFs, the setups are going to be on every possible market in addition to US stocks. So if the euro currency fits the criteria for one of the setups, you will get that setup. And I will let you know that it's a setup for a market that's not correlated to the stock market. And if there's a long position in the bond market, we will pick it up because there's at least 20 ETFs that follow the bond market. And the same goes for commodities and all the different global currencies. So if there's an ETF for a market, one of these strategies will pick the setup once it fits the criteria for that setup. So you're not going to get uncorrelated ETFs on a daily basis. But I find myself trading ETFs that are completely uncorrelated to the overall market at least a few times per month. You will know all the rules and the guidelines to each of the strategies that are part of the Swing Trading Lab mentorship program. So this way you know exactly what the rules are for the strategy and how the stocks or ETF ended up being on my setup list for the next day. So there's never any mystery. I stick to the exact rules of the strategies probably 19 out of every 20 trades. So there's never a question of why a specific stock or ETF is on the list, because each setup follows the rules of one or more of the strategies that I specifically describe in the individual strategy guide. And when the setup is based on a combination of two strategies, which does happen occasionally, I tell you which two strategies, so you can look up the strategies and make sure you understand why I took the trade. And the final component of the Swing Trading Lab mentorship program is the daily market analysis that I provide each day after the closing bell. The purpose of this is to keep you informed on events that really move the market, and not what you hear daily from the news media, which really tends to distort the real reason for the strong moves that we see in different markets. In this program, I focus on both the global markets as well as the US markets. Here I take a broader perspective and talk about global markets and how global markets may impact the US market on both the technical as well as the fundamental perspective over the next several days. So traders who are interested in my perspective on global currencies that are moving, or commodities or the bond market for example, will get a technical outlook on these markets and also get to see how these markets will impact the US market over the next several days. And the purpose of these reports is not to only help you understand what the markets are doing and why, but more importantly, to get you to start analyzing markets yourself using a simple top-down approach. So the reports are created to inform you as well as help you connect the dots yourself. This is very important because you don't want to rely on me forever. And these reports are designed to help you start thinking independently about market action. And as I mentioned earlier, there's 4 overlapping parts: market analysis, daily trade setups, financial lab, and closed trade tracker. And all 4 are designed to create synergy and reinforce the other parts, since they're all related to each other.
And this is a capsule summary of all trades taken between October of 2014 and April of 2017, just a few days ago.
I want to give you a bit more info about the closed trade tracker. In the members area, you can see the entire spreadsheet with all the details of what setup was traded, the entry price and exit price, and the exit date, and even the share size, so that each trade represents risk of $500. I show you how to size the trades in the Getting Started guide that comes with the program. And there's several guides as well that are part of this program to help you get up to speed quickly and easily. So I started keeping track of all the trades in October of 2014. And here's some info for you so you can see the overall propensity of my trading, at least so far. And based on my previous experience, this is in line with what I expect to see going forward. But as each of you know, there's no guarantees, and the picks that you select from the daily setups may outperform the setups that I trade. But this should give you a good idea of the results so far.
This is just over 30 months, just over 2 years.
And this is assuming you're risking $500 consistently on each and every trade. Notice the profit factor is around 3.5. This tells you that for every dollar that's risked, the profit is roughly 3.5, which is extremely high by any standard. Anything over 2 is considered highly profitable, and 3.5 is considered extremely profitable. Also, the percentage of winning trades is above 60%, which is considered very positive for a strategy that has such a high profit factor. You can also see the size of the biggest winner and the biggest loser. And the winner is several times the size of the loser. So the profit is always at least twice the size of the risk. And sometimes, if market conditions warrant, they can be substantially higher.
The performance over the past 30 months is over 557% as stated previously, or over 6 times the return on my initial investment of $50,000.
But remember, you don't need a large account to trade these setups. You can start with a very small account and build it up from there by adjusting the share size, which is very common for traders in this program. Lastly, when you enroll in the Swing Trading Lab mentorship program, you're going to have access to me and my staff. So if you have any questions or need clarification, we will respond to you 7 days per week. We want to make sure that all of your questions are answered, and we want to give you the best customer service possible.
We're very excited about launching the Swing Trading Lab mentorship program. And I know many of you have been waiting for a very long time for this program, or for the original program to open up. And we wanted to make sure we made it affordable for everyone. So we decided to offer 2 different programs. And each one saves you more than 50% off the price that we will offer the program in the future. The regular price for the 1-year mentorship is $19.97 and $29.97 for the 2-year program. And at those prices, we were sold out for a very long time. But today, since we have so many people waiting to get into the Swing Trading Lab mentorship program, and since you're such a Value Trading Concept subscriber, Todd and I wanted to offer this program to you at a fraction of the regular price. So for today, if you want to enroll in the 1-year Swing Trading Lab mentorship program, you can enroll for only $9.97, an immediate savings of $1,000. Or if you prefer to enroll in the 2-year program, you can enroll for only $14.97, an immediate savings of $1,500. And both programs will include the Sniper 7 strategy. And I'm including it because it's actually one of the strategies that we use in the mentorship program. So we're including it in the price as well. So if you're interested in swing trading with us for the next year or 2, I highly recommend the 2-year program, because it's the only time you'll ever see this price, and I really mean that. These are amazingly low one-time prices, so if you want to learn more and enroll in the Swing Trading Lab, you can go to the link at the bottom of this slide, and that'll take you to the page where you can learn more about the Swing Trading Lab mentorship program. I want you to know that Todd and I are only opening up 50 spots at these prices, and there's over 300 people who have been waiting for the chance to get into this program. So we highly recommend you take advantage of this one-time opportunity and visit the link at the bottom of this page if you're serious about your trading and want an all-in-one program that teaches you the trading strategies and provides you with the daily trade setups and gives you total market analysis along with unlimited support every step of the way. You've certainly found it here. So if you're looking for a smarter and more profitable way to improve your trading, we highly recommend you enroll in the Swing Trading Lab mentorship program. And my assistant, who's helping Todd and I, is telling me that 14 of the 50 spots in the program are already taken. So if you're serious about your swing trading, this is a great opportunity at an incredibly low price. It's really a no-brainer. And I want you to know that we stand behind the Swing Trading Lab program 1000%. So if during the first 30 days you take 10 trades according to the trade setups and you don't end up with a net profit, we will gladly return your purchase price. But I want you to know that we only have 36 spots left inside the Swing Trading Lab program. And I want to make sure that only serious traders have a spot. So please enroll only if you're really committed to your trading. This is a real mentorship program for real traders who want to take their trading to the next level. Again, please visit the link at the bottom of this page to learn more or to enroll. Alright, I just got a message from James that says he's happy that he was finally able to enroll after waiting for close to 1 year. And James, welcome to the program, and we're glad to have you here. You'll get something in your email shortly with specific instructions. And if you have any questions, James, just email us with your user ID, and you'll get a response very quickly. I promise you that.
Okay, let's take some questions. I have a question from Leonard, who's in Indiana. And Leonard wants to know if there's option strategies and setups. And Leonard, thanks for the question, and let me give you a clear answer. The setups that are posted daily are all based on stocks and ETFs. So there's an entry level, stop level, exit level, but it's all based on the underlying stock or ETF. So if you're looking to trade spreads or butterfly spreads, this will not help you. But if you want to trade directional options instead of the underlying stocks or ETFs, then this program will work well for you. I created some guidelines for trading options inside the members area as well. But in a nutshell, as long as you trade options that behave like the underlying stocks and give yourself enough time, then you can trade options instead of stocks or ETFs. In other words, Leonard, if you're taking directional trades, then this program will work great for you. But if you're an options trader who takes in premium or looks for arbitrage opportunities between volatility and other advanced options spreads, this won't help you, Leonard. So I hope that clarifies it for you, and thanks again for participating. Okay, we have a question from Nicholas from Atlanta. And Nicholas, I want to welcome you to the workshop, and thanks for participating. And Nicholas wants to know how much trading experience is needed to get maximum benefit from the Swing Trading Lab program. Nicholas, to answer your question, the Swing Trading Lab is designed for traders with different experience levels. If you're just starting out, you will get a tremendous advantage because you'll be able to learn the strategies and compare them to the daily setups and see how the whole process works, from analyzing the market to generating the setups and then to completing the trade. And if you're an experienced trader who's looking for high profit potential setups with low risk,
you can utilize that part of the service, since I generate anywhere from 2 to 4 trade setups daily for the next day.
And if you're an options trader, you can focus on the setups that work best with options. And many of the members love the program because they like the way I analyze the markets and give them a heads up if a major move is going to occur based on my analysis. So the Swing Trading Lab has something for everyone. And I hope that I was able to answer your question, Nicholas. And thanks again for participating.
Okay, according to my assistant, we only have 24 spots left. 26 have already been taken. And we have a question from Rick in Miami. And Rick, thanks for being here today. And Rick is asking how large of an account he needs to trade the strategies and the setups effectively.
Rick, thanks so much for participating today. The setups are based on stocks that are priced anywhere from $15 to a little over $100. And there's several setups daily. So there's always a setup for a stock that will match your price range. But what I do, Rick, is give you a suggested share size, purchase price, profit target, and risk level. So you know exactly what you're getting into every time you place your trade ahead of time. My recommended share size is based on $500 per trade. So if you want to risk $100 instead of $500, you would simply divide the recommended share size by 5, and that would give you the approximate risk per trade of only $100. And conversely, if you want to risk $1,000 per trade, you can double my recommended trade size. So the bottom line, Rick, you can trade a small account or a large account by simply modifying the recommended share size based on your personal risk tolerance by reducing or increasing the recommended share size proportionately. And I hope that I was able to answer your question, Rick. And thanks again for participating. And we have another question from Murray, who's in New Hampshire. Murray, welcome to the workshop, and thanks for participating today. Murray is asking if he has to sit in front of the computer or if he can trade these strategies and still work full-time. Murray, that's a great question. And you should know that these are swing trades that can last several days. This is not day trading, where you're going to be out by the end of the day. I trade many of these strategies without monitoring the market during the day. I place my orders, and I place my stops and my exits, and I go about my day. So to answer your question, the only thing you need to do is place the orders using the recommended price levels. It helps to understand the strategies, and my hope is that you will want to learn the strategies yourself. But you don't have to sit in front of the computer all day, Murray. And I hope that I was able to answer your question. Okay, I had a great time today, and I'm really looking forward to helping you become a better trader, and hopefully a more profitable trader with the Swing Trading Lab mentorship program.
There's less than half of the spots remaining now. The demand is real strong for the Swing Trading Lab mentorship program, which is a complete done-for-you mentorship program and trade alert service. So if you want to learn more, you can visit the link at the bottom of this page. All right, I had a terrific time today, and I want to thank all of you that attended. I really hope that all of you learned a great deal from what I taught you today. And I do apologize for going so long, but I really wanted to give you everything I had. Again, if you have any further questions, please go ahead and type them in the box below, and we'll be sure to answer those for you. I'm going to go ahead and hand the mic back over to Todd. Todd, are you there?
Yes, I am, and thanks, Roger. Absolutely fantastic presentation like always. All right, today was pretty long, so I'm going to keep this real short. And Roger pretty much answered all the questions that I see for now, but if you've got any other questions, be sure to type them in below, and we'll be sure to answer those for you, okay? Now, I see we have only 11 spots left inside the Swing Trading Lab mentoring program. Jeez, oh Pete. And again, I want to congratulate those of you who signed up and took your first step in partnering with Roger and me inside the Swing Trading Lab. It's an absolutely fantastic mentoring program. You're going to love it. Plus, you get daily trade signals to help you make money that much quicker with it. And it really doesn't get any better than that. All right. Now, I don't see any other questions coming in right now. So I want to thank all of you for joining Roger and me today, and we truly hope you got a lot of useful and most importantly, actionable trading information and strategies out of today's workshop training, okay? Again, to learn more about the Swing Trading Lab mentoring program and trade alert service, please just click on the link below. And if you've got any further questions at all, please just type them in below and we'll answer those for you, okay? Okay, then, this is Todd Mitchell wishing you lots and lots of success in your trading, and we truly hope to see you inside where you'll be able to partner with us, okay? Once again, thank you for taking your valuable time out of your busy schedules to join us today, and we truly appreciate it. We truly do. Bye for now, and again, if you've got any further questions, just type those in the box below, and we'll get back to you quickly, okay? See you soon.